Welcome into Turnkey on Queen City News Plus, your go-to show for everything real estate in the Carolinas. We talk about the latest market trends, do's and don'ts in the industry, and provide expert advice on navigating this dynamic landscape that we call home. And when it comes to buying a home, you may first start out by scrolling through the listings that are active, maybe on Zillow, but that's probably not where you should start. And you shouldn't even probably start with a real estate agent. You should probably start with a loan officer because you can't buy if you don't know the budget. We're going to bring in Stacey Kimry, who is a loan officer. Stacey, appreciate you coming on the show today. We're going to talk about demystifying the mortgage process, and you're also going to give some advice on some down payment assistance programs that might be out there. So before we get into all of that, we'd just love to hear a little bit about you. How long have you been in the industry?
Well, thank you for having me. It's an honor to be here. I've been in the industry for 30 plus years. We won't say exactly. So, but ever since,
you got to keep them guessing.
Ever since college. So it's all I've ever done, and I love it, and I have a passion for it. So,
what are some of the common misconceptions? We're going to dive right in. What are some of the common misconceptions in your 30 plus years of being in the mortgage industry that people have when starting that process?
I think probably the biggest misconception is they have to have a perfect credit, which is not necessarily the case. And if they do have credit that needs to be improved, we've got avenues for that. Mm-hmm. We at Town Bank Mortgage have a credit team, and most mortgage companies have a credit team that can help analyze a situation and not fix fake things for a minute at a time, but actually affect change for the overall period of the credit by manipulating balances, paying things down, creating a different overall input of credit, whether it be installment loans and revolving loans. So there's always something that can be fixed. If you've had a late payment, you've had a late payment. We got to move on from that. But there's other things that can be done to improve the credit. So that's one thing. The other common misconception is that they need 20% down, and they certainly do not need 20% down. We have several zero down programs, and then there's plenty of down payment assistance, which we'll get into later, specifically for first-time home buyers, but also for hometown heroes and second and third-time buyers as well.
You mentioned some of the programs that are available out there in terms of the type of loan that people could get. Mm-hmm. Most people, I would think, if it's their first go around, think, well, I'm getting a mortgage.
Right.
But there are different loans that people can get depending on their background, what they qualify for, correct? And we have some of them up on our screen right now.
Yes, so there's different mortgages, but they're all differently mortgage loans, but there's a home equity line of credit that you can do in first mortgage lien position, but typically that's a second mortgage lien product. But ones that people have heard of most often are conventional, which is Fannie Mae and Freddie Mac. Mm-hmm. Those are government-insured entities. But then there's also government-insured loans like FHA, which is the Federal Housing Authority, and that just gives for low down payment and is a little bit easier on credit scores, a little more forgivable on that. There's VA, which is for veterans, and then there's USDA, which is more rural properties. But VA and USDA both allow for 100% financing.
Looking at this, screenshot that we have up here, we see LTV a lot on there. What is LTV?
That is loan to value. So if it's a 97% loan to value, for example, on conventional, that means you're putting 3% down as the minimum.
Okay. So VA home loan, someone can finance 100%, meaning they don't need to put any money down for that.
No money down, right. And with the VA loan, you have to be a veteran. You can be in service or discharged from service, separated from service and retired. It can be a widow of a veteran can still get a VA loan. But for their service, they have the best rates typically, so which is nice because we want to honor our veterans. Mm-hmm. But it's 100% financing, and then there's typically a funding fee that's financed and 100% financeable, whether it's their first-time use or second-time use, if it's their first time around or their second home that they bought.
So if someone's not in the service, a lot of people wonder, how much money do I need to get this, to get the home? There are closing costs involved. How much should I even plan for? What's the lowest that someone could put down who's not a veteran? And what should they expect when it comes to closing costs?
So as far as minimum down payment for first-time home buyers, we've got several special programs. But USDA, anyone would qualify for, whether a first-time home buyer or not. But the property has to be in a certain rural zone. Mm-hmm. So it just depends on that. And there's income limits that apply. But any of the first-time home buyer programs usually allow for down payment assistance. And that can mean that you bring only $100, maybe $1,000 max to closing. So I've actually had somebody walk away from a purchase closing with about $158. So
that's not too bad.
Yeah.
That's
pretty
pretty
nice.
impressive.
Yeah.
So the process of applying for a loan can feel at times a bit financially invasive, we'll just say.
Yes.
Which hey, I get it. If you guys are going to give me the money for a home, I get that you want to know everything about my
Right.
finances. But what should people expect to be required to provide when they're going through the loan process?
So for the loan process, we need to know that you have a job. So we're going to ask for W-2s and pay stubs. We're going to need a 2-year employment history to know that you've been in the same line of work. Typically, if someone is recently self-employed, then they have to be self-employed for 2 years.
Okay.
Because we need to know that they can manage the ups and downs of being self-employed. As far as credit, we pull a credit report. There's certain minimum credit scores depending on the program. We need to see that they've repaid the loans that they do have before we extend them a big chunk of money for a mortgage, for example. And one thing about credit, I just want to interject. So a lot of folks check their credit and will call and tell us my credit score is a 760 or 780, which if they're checking Credit Karma, they're usually looking at a consumer score. But there's actually a different algorithm for mortgages and a different algorithm for the auto industry. So it depends on how much you're borrowing and what we put the risk and the weight on as far as what your score might be. The good news is if you're watching Credit Karma or some sort of credit monitoring system, if your score is going up, all 3 scores should be going up. So scores trend in the same direction, but they're rarely going to be exactly the same number.
I would imagine that would be potentially frustrating for someone who's like, well, I check my credit and it is fine. You need to rework your numbers over there. Do you get that a lot?
That said specifically to me. Exactly.
Oh, really?
Yeah. You need to check that. And I'm like, I can show you your credit report and I can show you why. So it just, if you've had a mortgage before, your score is going to be higher on a mortgage score.
So on the credit topic, when people are shopping around for loan officers, lenders, which they should do, right? You want to shop around 2 to 3? 2 to 3.
It just depends. You want to go with whoever you feel most comfortable with, whoever you, because it's a very invasive process. A lot of people feel like, because we do kind of delve into your history over the last couple of years, your future, what it's going to look like.
The thing you don't talk about, you talk about with a loan officer, which is how much you make.
Exactly. So, and with a loan officer, you want to tell your loan officer everything and let us filter out what needs to be poised in the story for the mortgage. So, whatever doesn't need to be included, we can kind of filter out. But that way, we've got the whole big picture, and we can put a bow on it and present it.
No surprises at the end. So when someone's shopping around and they do all those credit checks, your credit kind of could drop a little bit as you're going through that. Yeah. Do you suggest having your credit pulled for each loan officer all at the same time, or spreading that out? What is the least impactful on your credit score?
So you're going to want to have any credit pulls done within about 2 weeks of each other, within about 14 to 20 days of each other, because since you're shopping for a mortgage, we're promoting home ownership. So the score model adjusts for that. So if you have several credit checks within a 2 to 3 week period, it shouldn't affect your score. Past that, each inquiry should only affect your score about 4 points. But if you're right there at a 640 minimum, let's say, for a first-time homebuyer program, you can't really afford to lose 4 points. But if somebody's at a 720, 728, 4 points is not really going to affect them so much. But you want to get your shopping in early and get that done. That way, if there's any credit inaccuracies, lots of credit reports have things that are incorrect or just wrong that we can help have corrected that would initially improve the score. So
invasive process.
It's time to do that.
But you kind of need to go through it if you want to buy a home. Great information, Stacey. We're going to take a quick commercial break. But when we come back, Stacey's going to give us some little tips on what down payment assistance programs are available to first-time home buyers out there. More Turnkey after this. Welcome back to Turnkey. We are joined by Stacey Kimry with Town Bank Mortgage. She's a loan officer, giving us some really important information on how to start the home buying process, which starts with a loan officer such as yourself. Stacey, we've talked a little bit about what people need to do to apply for a mortgage, but how much should they expect to spend throughout this process? And I know it's like a loaded question. It's like, what do you approve for? But is there a percentage that people should plan in their head with down payment costs and closing costs of getting across that finish line?
Well, and this is where your real estate agent becomes key in the negotiation factors of this. So typically, minimum payment is going to be 3.5% to 5% down, unless we use some sort of down payment assistance program. Gifts from family members are also allowed for down payment. If people have a 401k, they can borrow from that for down payment. So there's different streams of income that they can draw from for their assets to use for down payment. But typically, if you're looking at 3 to 5%, and then as far as closing costs go, there's closing costs, which are the one-time costs of an appraisal, a credit report fee, attorney fee, title insurance. Those are one-time costs, and those are closing costs that should be less than 3% of the purchase price. Should be much less than that. But that's what realtors tend to gauge it on, is 3% of that. And then there's escrows, which is the account we set up for taxes and homeowners insurance, where we collect a certain portion of that up front so that we can make the homeowner's payment on their behalf when the bills become due a year from their purchase on their annual anniversary of that. So
they're not getting a bill in the mail that's unexpected, and they're like,
right.
I didn't save for this.
Exactly, because it's escrowed in with their monthly mortgage payment. So we collect that monthly. And then also from the negotiation part, it depends on if it's a buyer's or a seller's market, and we're kind of in a shift right now.
It's a little more balanced than it was.
It is, which is nice, and back to normal a little bit. But it's a situation where, as long as the value is there, the realtor may help negotiate for the seller to pay some of those costs on the buyer's behalf, if that's a thing. So,
and I know we're getting a little off topic, but there is a limit to. No, this is my doing, not yours. There is a limit to seller concessions when it comes to closing costs. You can't pass a certain percentage, right? On the loan side of it?
Yeah, so on conventional loans, it's anywhere from 3 to 9%, depending on how much down payment's involved. And then for government loans, it's a little bit more.
So let's say
it should cover everything.
Let's say someone's purchasing a $300,000 home, and they want a seller concession of $20,000.
So that's too much.
Too much.
Yeah. So they're going to have $9,000 as a 3% threshold for conventional, for example.
So they have to figure out where they can use the rest of that money, whether it's repairs or, okay. So you can buy down the rate?
Yes, you can buy down the rate. But the limit for the seller to pay towards closing costs is still going to be the 3% or 6% for FHA. So it just depends on the program. Okay. But one way to negotiate that is to either negotiate off the price of the house, but closing costs comes first, because that's dollar for dollar out of pocket what you're spending.
Okay.
If you're taking it off the price of the house, that's not really affecting your money out of pocket.
Okay. Okay. Getting back on topic.
Yes, sorry.
You mentioned some of the programs that might be available for mostly first-time home buyers, right? I can't imagine there are too many programs for down payment assistance available for people on their second, third, fourth
We
home.
do actually have
some, but yeah.
North Carolina and South Carolina Housing, both as a statewide program that's a bond program, offers down payment assistance for repeat buyers, which is nice.
Okay.
And then there are certain local municipalities that may offer for repeat buyers as well. But typically the majority of it, the bulk of it, is for first-time home buyers. But if you haven't owned a home in 3 years, you're a first-time home buyer all over again. So you don't have to be a first-time home buyer once in your life. You can revisit that.
You would have to then sell your home, move into a rental for 3 years, and then buy back in, and you could take advantage of whatever program is hopefully still available. If it's a different one, research it. Right. How do people go about researching what's available in what area? I know that we've got this graphic up here of one of the programs that's offered in Charlotte.
Right. So that's a city program for House Charlotte that's available for if you're buying within a certain map of Charlotte. It's covered within certain city limits. There are other city programs, Gastonia, Rock Hill, Concord, where you may not have to live within the city limits per se.
Okay.
It may extend beyond the city limits, but for House Charlotte, there's a specific map, and you can look up.
I think we have
addresses.
The map.
That's it.
That's it.
Yep.
That's the one we're talking about.
That's the one.
I mean, it covers a big area.
Yeah, and it's typically, like I say, city limits, and then there are certain areas that get more money depending on where in the city it is. But the House Charlotte program, for example, allows up to $30,000 of down payment assistance if you fall under the income threshold.
What's the income threshold?
It's the area median income. So in Mecklenburg County, that is $71,800. So they want you to be at 80% or less of that to get the $30,000. And what they're thinking is there on any of these down payment assistance programs is that with the income limit, there's also a minimum credit score. There's also a maximum purchase price. And it just works out that the maximum purchase price, you couldn't get there if you're under the income limit. So it kind of resolves that issue for you. But the income limit is the main thing. It's by the number of people in the household. And that is determined, like I say, by area median income by the county. And then as long as they fall under that amount, then they may qualify for $30,000. If it's over that amount, it's $10,000. And then that can be applied towards down payment and closing costs.
That's significant.
That's a lot.
When you've got people who are, probably just rubbing two pennies together trying to save money for the hope someday that they could buy a home, getting $10,000, whatever it is that something that they would have to pay back, or is that just straight up, here is some help?
Well, that's what the income limits are for the people that may struggle in saving money for down payment. So that's why the income limits are in place. But there's also repayment figures in place because most of the programs think that if you use our funds for down payment assistance and then several years down the road, you've had appreciation like you will have with real estate. It's the number one way to make a good return on your money and have a wealth investment. But that's just showing that if you've invested using their funds, then you would have the opportunity to pay those funds back when you sell the home or refinance the home.
Have the opportunity or...
Well, and it's just because if you buy, a $300,000 house, to use your example, and you get $30,000 from the city of Charlotte, plus you get $15,000 because we can layer these with the state of North Carolina. So that's $45,000 that helps you get into a house. So maybe you could have only afforded $300,000, but now you're getting a $345,000 house because you're getting an extra $45,000 in down payment assistance. Well, after 5 years, that home may be worth $450,000 or $475,000. So you're still going to make money plus have the money to pay back what helped you get there. Because if you didn't have their money to help get in the house, you wouldn't have experienced that appreciation or made that kind of
right. This is not a gift,
right? It's a gift for a certain period of time. For example, North Carolina housing after 15 years, it's fully forgiven, but there's no payment the entire time. So the same thing with House Charlotte. After 30 years, it's fully forgiven. But if you sell during that recapture or repayment time period, then they want to see their money back because typically you've made that and then some.
Yeah, that's fair. Yeah. So there are qualifications that people have to reach. We covered that. Location restrictions, at least for the Charlotte program, we have that map up on our screen right now. But are there other programs? A lot of people always focus on Charlotte. Obviously, it's a big city. But what about towns like Matthews or the surrounding area? Are there programs available in each city for someone buying a home in Gastonia or another smaller town, maybe?
Yeah, so the state covers all counties in North Carolina. South Carolina has a statewide program as well. And then we have a federal grant program that affects anybody. So we can layer some of these and some of them not. But I would say once you figure out where you want to be, what municipality or what city you want to be in, then we can investigate for you or with you from there to see what is available because Gastonia's got a city program. Huntersville has an extension of House Charlotte that they just took over this year. Okay. And then the House Charlotte program even does matches where if you get 30 from House Charlotte and 15 from the state, if you're getting 15 from the state, then Charlotte will match that additional. So you get an additional 15. So it can add up pretty quickly. And so different city programs can be quite different. But Rock Hill's got one. So Salisbury, I just found out last week, has one, which is awesome. So
it can be so overwhelming, and I'm so glad that earlier you said we can look at what programs you might qualify for because I think again, diving into homeownership in and of itself, it can be overwhelming, especially if you're trying to find out what programs are available. Just finding the website for some of these programs may seem like an uphill battle. So I appreciated that you said we, because you are the expert right. And you can rattle these off at the tip of your tongue and no problem, whereas someone else might spend days researching.
Well, Salisbury, for example, I haven't had many ask for that. So I went and I was looking for China Grove versus Salisbury, and that made a difference of which city they ended up buying. And they had one property in each, and they preferred to go for the down payment assistance. Which,
I mean, money talks.
Yeah.
Yeah. If you can get more help somewhere and it can give someone a leg up, For sure.
And each website it's supposed to be very user-friendly, and it is-ish, but even from being in the industry, I can tell you that it can be tough to navigate sometimes. I did have one client, shout out to you, Marcus, who was a city employee who knew more about the House Charlotte program than most loan officers do. And so he had done his research online. He had worked with his realtor who knew a lot about down payment assistance. So he had his ducks in a row when he came to me, which was awesome.
And this was Marcus. Marcus, you're a hero, man.
Yeah,
All right. We're going to take one more quick commercial break. When we come back, the crazy scenarios that Stacy has navigated to get to the closing table and some of the mistakes that maybe some buyers make when they're going through the process. We'll be right back. Welcome back to Turnkey on Queen City News Plus. We've been talking about the loan process and mortgage process as people look to buy their first, second, third home, whatever it may be. Stacy Kimmery has been helping us kind of navigate those topics. And Stacy, it's not over until it's over.
Right.
You have navigated some interesting scenarios, I'm sure, over your 30 plus years of being a loan officer. What are some of the things that home buyers do, mistakes that they make that could prevent them or have prevented them from being able to close on a home?
So number one, just we had mentioned before, tell your loan officer everything and let them decide what needs to be in the file or not in the file. Just because some information is extraneous information that the underwriter doesn't care about and some they care about a lot. So, but of those, if you're paying your bills, keep paying your bills. If you're buying something, best not to go for that Labor Day sale. Just wait till after you've closed on the house to buy everything.
Credit card. What's the big deal?
So let me open up a new credit card. Let me go buy a new
Open a new credit card. Why is opening a new credit card so detrimental?
So number one, it can affect their credit score. So if they're right there on the borderline, that could make or break the deal.
Because the number of credit lines that you have open will impact the score and the length, right?
Right. The inquiry, number one, will affect your credit score, plus any new credit that doesn't have a history with it, because 15% of your score is your credit history, how long you've had it, the length of the account. So it's a brand new account. That can help the debt. If there's anything incurred, if you borrowed something on it, didn't just open something, that could affect your debt ratio, which could throw things out of whack. So there's several problems with that. We've had people buy a new car, which they should know better. We tell them up front, don't move money between accounts without tracking the money because we've got to track it. Mm-hmm. Don't get new credit without asking us first. Some borrowers are really over intensive about it, and they say I can't apply for Duke Power until you tell me to, which is not the case. Mm-hmm. It's just don't go buy a boat if you're buying a house on the lake, because you may be living in that boat instead of living in that
boat instead of the house.
Yeah.
You'll be looking at the house from the water, and someone else will be living in it eventually.
Yeah. Yeah. And then, we had somebody that was arguing with over a internet bill and didn't return the box, and then got turned in for a collection the week before closing and dropped their score 100 points.
Wow.
So
that had to have been going on for a while, though, if they sent it to collections, right?
Yeah. So, but we just, I guess it was negotiating until the very end, and then when they didn't return it, we had to do a credit refresh within 3 to 5 days of closing, and that just checks to see if someone's extended new credit in some way or had a major malfunction in their credit, like this case was. So
that really is a shame. Did the person end up closing on the home, or did
we ended up negotiating with the creditor, and they minimized the impact of the late payment? So we were able to work with them on that.
Things that you wouldn't think, conversations you wouldn't think you would have had, right. and things that you wouldn't have thought that you would have had to do as a loan officer,
right?
Is negotiating that.
If you're buying a house, don't quit your job. I mean, that was one thing. We had somebody that it was a better job and more money and better benefits, and I'm like, I totally understand that, but you got to tell me that before, because we do a verbal verification of employment within 3 days of closing, and all of a sudden she hadn't worked there in 2 weeks. So we had to delay closing a couple of days to get the new verification of employment. Mm-hmm. And that was okay. That worked out great. Now,
a lot of great things happening in
right.
that customer's life, right?
That client's life. New house, getting married, getting a new job, all happy things. But just let somebody know, because I had one where if she had gone to 1099 versus W-2 income, it would have ruined the whole loan. So luckily it was the same type of pay, same type of work, all the things. So it ended up working out just great for everybody.
You're the friend, not the enemy.
Panic strikes.
Loan officer is a friend, not the enemy.
Exactly. Yes. Help me help you.
Yes. Help me help you. I like that. one more final question for you because we have a teeny bit of extra time. But when looking at trying to qualify for a loan, should someone pay off their debt or increase their down payment? What looks better?
So you should talk to your loan officer before doing either one. You won't have down payment until you close on the loan anyway, but we can look at different impacts of additional down payment. So I had one, for example, where the borrower just insisted on paying 10% down and was getting a gift from their wedding to pay that 10% down.
Who are all these people?
So I know, right?
I know. I just get a microphone.
And it was fun for that because it was through a GoFundMe, and they got $100 here and $100 there. So that was fun to track. But I explained to him that putting that extra 5% down, each extra $1,000 down only saves about $6 or $7 a month, versus he used that same $10,000 to pay off his car that was $320 a month. Mm-hmm. So paying down the mortgage only saved him, I think in this case, like $72, versus paying off his car saved $320.
You got to crunch the numbers.
So so cash flow wise, it made more sense for him to do that. So,
Stacey, any final thoughts or pieces of advice for people looking to purchase a home?
Trust your loan officer. Hopefully you got a good one that knows what they're doing. We're licensed for a reason. It's up to us to research this information for you. Don't do this on your own. You're welcome to investigate as much as possible and do your research, but you don't have to do it alone. We're here for you, and I want to be your lender for life, so we treat it as such, and want to get everyone in a new home if we can.
Thank you, Stacey. You have been an absolute delight. Appreciate you coming on our show. And thank you to everyone else out there for watching Turnkey on Queen City News Plus. We will see you next time.
Queen City News Plus. Just search Queen City News on your smart TV's app store.